Welcome to our Taking Stock video for the week ending the 9th of February 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Analyst, Jason Yin, to stream to you all things share market. Welcome, Jason. Happy Lunar New Year to you.
Well, thanks, Ken. Hopefully we get a lot of red pockets.
Red packets. I think we'll be giving out the red packets, given we've got so many nieces and nephews, Jace. But yeah, before we get started, just a quick yet important reminder: the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, Jace, the markets, both here and also in the US, they continue to hold ground over the week. And I've noticed that the market strategists, they are becoming increasingly confident that the market rally has further to go amid hopes of the soft landing and also a solid earnings season, specifically driven by the mega caps, especially in the US, such as Alphabet, Apple, Amazon, Microsoft, and Meta.
Yeah, that's right, Ken. There's certainly a lot of positivity in the markets, but if we were to step back a little bit and actually look at the data, so outside of the mega caps, results from the US earnings season to date has actually been pretty subpar. If we were to strip out the earnings impacts from the largest companies in the S&P 500, the remainder of the constituents would actually show an earnings decline of around 10.5%.
Very interesting, Jace. And could this be a lead into our reporting season? I noticed with regards to hopes of interest rate cuts, though, the US Fed, they did mention that rate cuts were not imminent and that expectations for up to 6 cuts in 2024 were too optimistic. This coincides with our own RBA, who this week kept the cash rate constant at 4.35%, but they did state that they did not expect cuts to come through until 2025. As you can see from the chart on screen, rate cut expectations for Australia are expected to begin later than the other economies.
It seems like there's a bit of musical chairs happening with the central banks. But speaking of interest rates, Ken, our observation this reporting season is that higher rates are actually starting to impact borrowers. For example, if we were to look at Credit Corp's financial presentation, which can be found under Golden Rule 8, management reported higher delinquencies as well as a lift in realized losses. But despite these deteriorating trends, management kept loss provisions unchanged since 2022. Now, we are a little bit concerned the business may not have a sufficient buffer against potential future credit losses, especially against the backdrop of a tighter economic conditions. Now, this could give rise to potential write-downs of the loan book. And given these headwinds, we're pretty happy to stay on the sidelines and actually observe how the company goes.
Yeah, feel free to jump into the strategic comments there for Credit Corp. Ryan's provided quite an insightful overview. But during the week, Australia's 2 leading energy firms, Woodside Energy and also Santos, they announced the conclusion of their merger discussions. Jace, the talks wrapped up without reaching a deal, primarily because the potential synergies expected from the merger were not sufficiently identified.
That's right, Ken. The news was not the Goldilocks outcome that Santos investors wanted. At the beginning of the merger talks in late 2023, the market was already skeptical of this potential tie-up between the 2 largest energy behemoths we have in this country, because of the fact that the price Woodside could afford to pay was unlikely to satisfy Santos shareholders. I wrote a pretty detailed note on this in the Insights page in December, whereby I thought the premium that Woodside could comfortably offer was around 10 to 15%, assuming no synergies. Now, they could have gone higher, but cost and revenue synergies were thought to be minimal, and this is ultimately what led to both parties parting ways.
Yes, and Woodside is a stock holding within our portfolios, but the share price reaction suggested that the Woodside shareholders, they were relieved that they would not have to pay a premium to get the deal across the line. However, the share price of Santos, though, fell quite significantly because investors were disappointed from the lack of a formal offer from Woodside, which meant that it would reduce the chance of other bidders coming in. Now we turn our attention to hearing implants provider and star growth stock Cochlear. The code is COH. The company's share price was sold down at the start of the week, only to bounce back on an earnings upgrade, Jace. What happened here?
Well, Keen, at the start of the week, an investment bank downgraded their view on Cochlear because Moderna, which is a large US pharmaceutical company, was developing a vaccine that aimed at protecting children against a virus that caused hearing loss. The vaccine has not yet been cleared for phase 3 trials, but the investment bank saw potential earnings risk for Cochlear if Moderna does make further progress on this vaccine.
Jace, this reminds me of the pressure ResMed was under when
Mm.
the whole market was paranoid by the impact that weight loss drugs would have on the volume of patients requiring treatment for sleep apnea.
Yeah, that's right, Kian. The share price volatility could also present an opportunity for some investors. Later in the week, Kian, a lot of the sellers in Cochlear stock were actually left a little bit dumbfounded because Cochlear management came out with an upgrade to its FY24 earnings by around 8%, which is a lot better than anticipated. The driver of this was better than anticipated cochlear implant volumes. The upgrade should reflect better results in Golden Rule 3 over the coming days and should support the company's attractive return on equity of around 20%.
Yes, Jason, and also provide certainty when they release their results. Moving on to another business with a strong market position, I noticed online real estate platform REA Group, they announced their results this week. On first view, it seems like revenue were ahead of expectations, but management did guide for higher cost, Jace. What is your takeaway on the company's financials?
Well, the first half 24 result was supported by positive national listings, in particular to the strong volumes coming from Melbourne and Sydney. And this provided the attractive backdrop for high residential revenue from the company. The management also gained from a 13% increase in price rises, as well as an improvement in depth penetration, which means that a lot of agents migrated to the higher cost products. But offsetting a lot of this was management's guidance for higher costs. And this was up from the previous qualitative guidance of around low to mid teens to now mid to high teens over FY24.
Well, I guess much of the high expectations have been baked into the share price. So
Mm.
when management did guide for those higher costs, the share price was sold down. This may also lead to negative earnings revisions to forecast estimates. So just keep an eye out on this.
Yeah, that's right. I mean, overall, the key takeaway is we still believe that REA is a high quality company with strong earnings growth prospects. However, we believe the growth has been factored into the current share price, hence why we are patiently waiting on the sidelines for a more balanced risk to reward entry point.
Yes, Jace. Other companies that reported their results were Star Income stocks and listed property companies, BWP Group and also Charter Hall Long Wale REIT. Now, BWP is undertaking the acquisition of Newmark Property REIT, while Charter Hall Long Wale REIT, if you can recall, they previously downgraded guidance due to higher debt costs. Will these issues impact the sustainability of dividends going forward for these two companies?
Good question, Ken. For BWP Trust, the acquisition is expected to be neutral for the unit's distribution guidance of around 9.3 cents per share for the second half of FY24. Now, the extra income from Newmark's property portfolio should support the additional distributions made to newly issued shares. Currently, BWP is on a gross dividend yield of around 5%. Positively, Charter Hall Long Wale REIT has reaffirmed its FY24 dividends of around 26 cents per share. The income is partially hedged, around 52% of leases are CPI linked. Given the exposure to the more vulnerable areas of the property market, such as offices, investors are compensated by a higher dividend yield, which currently sits at 6.7%.
Yeah, those yields are quite attractive, but for now, we believe both REITs are attractively priced. Note that Charter Hall Long Wale REIT, they have an upcoming ex-dividend date at the end of March. They also pay quarterly distributions, unlike BWP, who pay half-yearly distributions.
Now, with reporting season in full swing, there are going to be numerous results out next week. Some of the interesting star stocks will include CSL, Endeavour Group, IDP Education, Pro Medicus, West Farmers, and Objective Corp. For the full list, please refer to our corporate calendar.
In Under the Microscope this week, we take a look at an interesting business, X-Star stock and operator of KFC and Taco Bell brands across Australia and Europe, Collins Foods. The code is CKF. What has sparked our interest in this stock is the more favorable outlook following strong positive earnings revisions, despite lingering inflationary cost pressures, Jace. So, what has driven the strong earnings revisions?
Well, Keen, the earnings outlook has brightened for Collins Food after it beat market expectations following the release of results at the end of November. The business was able to stem a 3% drop in like-for-like sales by rising the prices of menu items by around 13.5% and also rolling out new stores. In addition, its value proposition makes the business more defensive than traditional restaurants.
Yeah, very interesting. With earnings growth expected to be over 20% this year, Jace, do we view this stock as a potential star stock in the future?
Well, it could be, Keen, because a lot of people still like KFC. The business remains pretty high quality, and we need to be mindful of the risks at the present. Profit margins are pretty low at under 5%, which doesn't leave a lot of buffer in the event of higher input costs such as chicken, labor, and also transportation. The company is also facing a class action regarding the potential breach of fair work policies. And in addition, the penetration of KFC stores are nearing capacity, so organic growth may be limited to around 3.5%.
Some good points there, Jason. Following the strong share price rally, though, especially over the last few months, our analyst Charlie, he believes the company is trading close to fair value at these levels. Although we do believe the business has strong fundamentals, we would prefer to sit on the sidelines just now until a more attractive price point emerges. And with the reporting season in full swing, a useful question for investors this week is, how can Stock Doctor help me monitor stock announcements and results?
Well, first and foremost, ensure that your portfolios are up to date within Portfolio Manager. Then you can set up alerts to monitor stock announcements and changes to the fundamentals. To set up alerts, navigate to Alert Manager under Tools, create a new alert, enter company code, and select from 4 categories with some key ones including star stock changes, earnings revisions, price-sensitive announcements, days until ex-dividend, and technical triggers like SD30 TSR. Alerts can also be processed intraday, and we will notify you within Stock Doctor via email.
Thanks, Jace. And aside from the Alert Manager, there's also the corporate calendar. Here you can access the report dates, AGM dates, and ex-dividend dates, but just be careful here. If there is an asterisk next to the stock code, it means that the date has not been confirmed with the company and is estimated by our system.
That's right, Ken. And also at the individual stock level, you can access upcoming corporate events by clicking on the date item on the top of the 9 Golden Rules page.
And these tools will help you stay on top of your portfolio during the reporting season. And as always, feel free to contact us or attend our Lincoln Live webinar if you have any questions. The research team will be extra busy analysing the result, but we will endeavour to return your call in a timely manner. Thanks, Jace, for your valuable insights. Great to have you on board again.
Hey, it's always good to be back on the desk, Ken.
And also, we are pleased to announce the return of our masterclass program in Melbourne and Sydney. That's an immersive full-day event led by Tim Lincoln, myself, and Matt Swartz to help you select the right stocks and give you the knowledge you need in order to use Stock Doctor to help you construct a successful portfolio. We plan to send out invitations next week, so keep an eye on your inbox. With reporting season here, make sure you use all the Stock Doctor tools at your disposal to keep on top of your portfolio. We expect a few star stock changes this month as well. Take care and have a happy, healthy, and prosperous week ahead.